The stock market might seem a complex maze of numbers and charts, but it's actually quite straightforward once you understand the basics. Think of it as a giant marketplace where instead of buying vegetables or clothes, people buy and sell pieces of companies. At its core, the stock market is where companies raise money and investors try to grow their wealth. When a company needs funds to expand or launch new products, it can sell shares to the public. These shares represent tiny ownership stakes in the company. If you buy shares of Reliance, you literally own a small piece of that business. This ownership gives you a claim on the company's future profits and assets. In India, we have two main stock exchanges that form the backbone of our financial system. The Bombay Stock Exchange, or BSE, is our oldest exchange, established way back in 1875. It has over 5,000 companies listed and tracks the top 30 companies through its famous Sensex index. The National Stock Exchange, or NSE, came later in 1992, but quickly became the largest by trading volume. It tracks the top 50 companies through the Nifty index. Both exchanges use cutting-edge technology to handle millions of transactions daily. The stock market operates in two distinct segments that serve different purposes. The primary market is where companies first sell their shares to the public through initial public offerings, or IPOs. When a company like Zomato or Paytm goes public, they're entering the primary market. Here, money flows directly from investors to the company, providing fresh capital for growth and expansion. The secondary market is where the real action happens daily. This is where investors buy and sell shares among themselves. When you check stock prices on your phone, you're looking at secondary market prices. These prices change constantly based on supply and demand, just like any marketplace. The secondary market provides liquidity, allowing investors to convert their holdings into cash whenever needed. Companies issue different types of securities to meet various investor needs. Equity shares give you ownership and voting rights in company decisions. Preference shares offer fixed dividends but limited voting power, providing more stability. Bonds are essentially loans you give to companies or the government, earning fixed interest over time. Derivatives like futures and options are more complex instruments that derive their value from underlying assets, allowing sophisticated trading strategies. The market participants include retail investors like you and me, institutional investors like mutual funds and insurance companies, foreign investors bringing global capital, and market makers who provide liquidity. Stockbrokers act as intermediaries, helping us place buy and sell orders while ensuring smooth transactions. Stock prices move based on various interconnected factors: company performance, quarterly earnings, economic conditions, government policies, global events, and investor sentiment all play crucial roles. When more people want to buy a stock than sell it, the price goes up. When selling pressure exceeds buying interest, prices fall. This constant price discovery mechanism ensures fair valuation. The Securities and Exchange Board of India, or SEBI, regulates our markets to ensure fairness and transparency. They set comprehensive rules for companies, brokers, and investors to prevent fraud and manipulation, maintaining market integrity. Trading happens electronically through sophisticated systems that process orders at lightning speed. When you place an order through your broker's app, it gets matched with opposite orders in milliseconds. The entire process from order placement to settlement typically takes 2 days, ensuring secure transactions. Understanding market indices helps gauge overall market performance effectively. The Sensex and Nifty are weighted averages of the constituent stocks. When these indices rise, it generally means the broader market is performing well, reflecting positive economic sentiment. For beginners, it's crucial to understand that stock investing involves inherent risks. Prices can be volatile in the short term, but historically, equity markets have provided good returns over longer periods. The key is to invest money you can afford to lose and maintain a long-term perspective with patience. The stock market serves a vital economic function by channeling savings into productive investments, helping companies grow and create jobs. For investors, it offers an opportunity to participate in India's economic growth story while building wealth over time through disciplined investing.